Green is good. Red is bad. Not that deposits necessarily are bad, but that's a liability. It's something you owe. And then gold is your buffer. Well, what this yellow and green is showing, those liability, those losses, that the gray from the picture exceeds the gold. When the is bigger than the buffer, you're out of business. So technically, the banking industry is insolvent. And that's a scary thing to say out loud.
Over the past months, more financial experts have been touting a sentiment that Bitcoin and crypto enthusiasts have been touting for the past decade. The banking sector is a gigantic smokescreen, and it's all about to go up in a puff of air. The SPDR S&P Bank ETF, which provides exposure to the banking sector in the U.S., relies on interest rates and economic growth to provide adequate returns for the sector. However, with the unprecedented rate of interest rate hikes in 2022, the Federal Reserve created hundreds of billions in unrealized losses in investment securities for banks, and those losses are quickly changing from unrealized to realized losses. To really put the situation into perspective, let's quickly examine the KBE ETF's returns, which have been extremely volatile over the past year. The fund recorded one-year returns of minus 12.30% compared to three-year returns of 10.64%. But the problem now is not just the Fed's sledgehammer or the fake assurance from these giant corporations that everything is well while they struggle to buffer their balance sheets. The problem is that customers and depositors are catching on fast and demanding their deposits, which the banks simply do not have. On Wednesday, Silicon Valley Bank announced it needed to raise $2.25 billion to shore up its balance sheet, causing a mass hysteria, which within 48 hours ended the bank's 40-year run. In addition to the largest U.S. banking failure since the 2008 financial crisis and the second largest ever crypto-focused bank, Silvergate Capital also announced it was closing down operations and liquidating its bank. During the latest recent episode of the Weekly Roundup with Blockworks macro, popular veteran investor and venture capitalist Mark Yusko discussed the fragile balance between a bank's assets, liabilities, and equities, which for a bank are basically loans and securities, customer deposits, and a buffer, usually in the form of equity or other capital, so that when banks mess up the business end of their operations, depositors don't suffer the consequences. But what happens when a bank does not earn as much on loans and securities as it pays on customers, depositors, and the capital it holds? You get a big which if customers catch up on can cause an instant bank run. We will now bring you Yusko's detailed explanation of this situation and possible ripple effect on the rest of the industry. Please watch the video to the end, subscribe to the channel, and turn on post notifications so you never miss any of our regular uploads. Also, ensure you drop your comments and observations in the comments section below. Everything helps with the YouTube algorithm and contributes to the channel's growth. Thanks, and enjoy the video.
There's going to be a bailout. It's going to happen this weekend. And, I tweeted at Senator Warren and the rest yesterday about, explain to me how JP Morgan lost more yesterday in market cap than Silvergate Bank was ever worth. So Silvergate at the peak was 16 billion. Today it's like 100 million. At the peak, 16 billion. And JP Morgan lost 19 billion yesterday. Silicon Valley Bank lost more, 75 times more than Silvergate did yesterday, and is losing again this morning. So help me understand how this is a crypto problem. This is not a crypto problem. This is a good old-fashioned bank run. If you go back, the last time we had this was in the global financial crisis. And I remember it well. You had a company that on Friday said, "We are fine. Our liquidity is excellent." And on Sunday, they were taken over by JP Morgan, and they opened up Monday down, 80 some odd %. And that was Bear Stearns. And then the whole global financial crisis started. So I think we are perilously close. A simple business. Banking is a very simple business, but it relies on trust.
Yes.
Right? We have to trust that the bank is prudent in making loans, which for the most part, they are. I mean, they actually are, but for the most part. You have to trust that they are prudent in their balance of securities and loans. Something broke down there, though. So when foreign governments rejected the US, for lack of a better term, and there was this alignment of the two axes in the world, and the Chinese stopped buying, and the Russians stopped buying, and Japanese stopped buying treasuries. And at the same time, we decided to increase our spending by handing out stimulus checks et al. Post 2020. What happens? Deficit, massive, trillions, 4 trillion at the peak. Well, if you have 4 trillion of deficit that you have to finance, you have to issue more bonds. If you issue bonds, someone has to buy them. Right? If you're a seller, someone has to buy them. Well, if there's no buyers, what you can do is you can basically mandate that the banks buy your bonds. Now, it just so happens they need to buy these bonds, as Michael just showed you, because as that stimmy checks get sent out to individuals and tax cuts go to corporations, they do something with that money, they put it in the bank. Well, when you put money in the bank, it creates demand for either loans or securities, bonds. Problem is, everyone had a lot of money, so they didn't want to borrow any money. So commercial lending activity collapsed. Everybody was locked down. Nobody wanted to borrow money for anything. So we just happen to have this surfeit of bonds that you can buy. Well, it just so happens that because we're not paying any interest on those bonds, you have this problem. And this is called financial repression. So when a central bank limits the amount of interest by artificially manipulating interest rate markets, you force people to go further out on the risk spectrum.
For banks, just like every other sector and institution, returns are heavily impacted by interest rates and general economic conditions. With the Fed's sledgehammer to combat inflation, what we've had over the past year has been one of the worst periods of wealth destruction in history. In February, Martin Greenberg, the chairman of the Federal Deposit Insurance Corporation, FDIC, revealed that FDIC-insured banks accumulated $620 billion in unrealized losses on investment securities during the fourth quarter of 2022. Here is a statement from Greenberg's speech explaining the details of a chart, which Yusko describes as the scariest chart ever. This chart shows the elevated level of unrealized losses on investment securities due to high market interest rates. Unrealized losses on available for sale and held to maturity securities totaled $620 billion in the fourth quarter. The combination of a high level of longer-term asset maturities and a mode rate decline in total deposits underscores the risk that these unrealized losses could become actual losses should banks need to sell securities to meet liquidity needs. Let's get back to Yusko's interview as he discusses just how scary this chart is.
This is the scariest chart that might exist. This is a very scary chart.
This is not great. So, Mark, can you kind of walk us through what we're looking at here?
Yeah. So it's basically a long-term chart of the either accumulated gains or losses of the banking system, and what that means essentially. How would you have a gain? Well, a gain would be you bought an asset, a bond, and interest rates fell. You have a gain. Or you bought some equity and they went up. And usually banks don't buy a lot of equities, they buy a little bit of equities. They're not supposed to buy a lot of equities, but they did buy some equities. And equity markets were rising. And so on the left-hand side of the chart, you see a lot of yellow, and it's above the zero line. And there's a little bit of downturn, a little bit of fluctuation, but generally speaking, banks aren't supposed to be taking lots of risk.
Right.
In these assets, because remember the asset liability mismatch. If your customer can take their money any day, literally any day, intraday, you probably shouldn't lock up the money for 5 years, 10 years, 20 years, unless you do it, as Michael said, in a very diversified way. Like if you lend for mortgages, okay, people aren't going to pay their mortgage back right away. But as long, again, as not everybody wants their money. And this is literally, this chart is a precursor to the scene from It's a Wonderful Life, where everyone rushes to the building and loan. And the one guy, he says, Joe, how much do you need? He's like, I need $220. He's like, no, that's all your money. How much do you need to get by through the week? Say, well, I need my $220 because I'm afraid. Well, Joe, your money's not here. It's in, Mary's house and John's house. And that's how banks work. The money's not in the bank. It doesn't sit in the vault. So anyway, back to the chart. So on the far right side of this chart, you see this cataclysmic, orders of magnitude, 4, 5, 6, 8 times more losses than gains that they're unrealized. And what that means is, as Michael said, as this massive wave of deposits came in 2020, 2021, even into early 2022, all these banks, Silicon Valley Bank, for example, went from 60 billion in assets to 180 billion in assets because there were a lot of companies formed, a lot of new businesses, there were a lot of ICOs, and people got all this money and they had to do something with it. So they put it in the bank. And so couldn't make loans. So what they bought securities and they bought treasuries and government bonds. On top of it, there was this little problem last year that the Fed started liquidating, because the Fed used to buy all these bonds. If nobody else was there to buy them, the buyer of last resort, the Fed would buy them. Well, then the Fed started QT. So they started selling, particularly these mortgage-backed bonds. And guess who was there to buy them? Because they're government guaranteed. So the banks started buying them. Well, unfortunately, when interest rates go from 0 to 5, you could do math on a zero duration bond. You don't have a lot of loss. 1 year more, 2 year more, 5 year, 10 year. Whew. Now you're talking big numbers. And the problem is these bars on the right-hand side of this chart, basically, if all the banks experienced a run and everyone took their money out, right, to stuff it in the mattress, which is kind of what happened during the global financial crisis, which is kind of why the socks I have on exist, which is all the banks started to fail. Literally, all the banks around the world started to fail, and governments literally had to step in and bail them out and calm the panic. Because what this chart is showing is, remember Michael's chart, or what was the guy, Jesse's chart? Green is good, red is bad. Not that deposits necessarily are bad, but that's a liability. It's something you owe. And then gold is your buffer. Well, what this yellow and green is showing, those liability, those losses, that the gray from the picture exceeds the gold. When the is bigger than the buffer, you're out of business. So technically, the banking industry is insolvent. And that's a scary thing to say out loud.
The effects of the Fed's sledgehammer are now beginning to hit home properly. The central bank's next move will determine how much more of a ripple effect will spread to all sectors, including stocks, housing, and others. Do you think this will force Jerome Powell to stop his Volcker worship and ease up on the rate hikes? Or do you think the fight against inflation will outweigh the need to play the hero on Powell's part? Let us know what you think in the comments section below. Also, ensure you give this video a thumbs up, subscribe to the channel, and check out our other videos. Thanks for watching.